Hey, Bowtie Nation. Thank you for being here. Joseph Hogue here with you as we are every Monday at 9 a.m. Eastern, getting you ready for the market. What we're looking at in the market this week. Big stock market news this week from from a lot of the tech companies. In fact, a lot of companies, period. Stock market earnings from 175 companies in the S&P 500. It's about a third of the market right there reporting earnings this week. And like I said, most of the big tech companies, we've got Facebook, which is Meta now, which I will never call Meta, Google, which I'll still call Google and not Alphabet, Facebook, Amazon, even Coca-Cola reported earnings this morning. We'll talk about that, talk about some of what we're watching, what we're expecting from some of those earnings, as well as what we're watching for the rest of the week. So already see a lot of you there out there in the Bowtie Nation in the chat. Love seeing you here. Thank you again for being here. I love these face-to-face personal connections we get from these live streams every morning, every Monday. So we're gonna get started here. Talk about some of the biggest surprises in earnings so far. Some of the stocks that we're watching this week, and leave it open for some questions there towards the end. But I do want to get started. I do want to also invite you to a special webinar, a free webinar that I'm doing along with another YouTuber there that is the stock signals. Now, we cover most of the fundamentals, the analysis here on the channel, but there's also something to be said for that technical analysis, understanding the stock signals, the buy signals, the sell signals that you get, watching the charts, making up your own charts, and that kind of thing. So teamed up with another YouTuber to give a stock signals technical analysis webinar. It's totally free. It's going to share the three stock signals that we use the most, just to kind of get those buy and sell points to kind of supplement your fundamental analysis. So I put the link in the chat there. Check that out. It's totally free. Again, I'll put it in the description as well, and hope to see you there. But I want to get started here because, again, we do have a big week for tech stocks as well as for the rest of the market in earnings. We've actually seen very positive news on earnings so far this quarter. 79% of the stocks in the S&P 500 that have reported, about 1 in 5 stocks in the S&P 500 have reported so far, about 20%. 79% of those have beaten expectations, which is pretty normal, actually. Maybe a little bit higher than normal, but it's pretty normal for companies and management to be able to beat those expectations because, of course, they manage them coming into the quarter, right? They always give that negative outlook. They say, I don't know if we're going to be able to do quite as well as we thought we would. They try to manage those expectations by analysts down a little bit so they can then come in and beat them, when they actually report those quarterly earnings. Makes management looks good. It justifies their $1 million paychecks, I guess, in some way, and they feel better about themselves. But so it's kind of a big game, and you start to learn that when you work as an analyst. But 79% of companies are beating their expectations. Growth so far this quarter for the first quarter, but from the first quarter of last year is 6.6% earnings growth. Which is a little bit above expectations, like we said. Looking out further, analysts are expecting about 7.2% earnings growth for the second quarter, and then 11 and 10% for the third and the fourth quarter. So we are expecting the economy to keep growing, corporate earnings to keep growing, and actually keep growing at an accelerating pace. So getting a little bit better there, a little bit of positivity for the markets right there. I want to look at how the market is opening today. Some of those stocks we're watching. The biggest surprise in earnings so far this quarter, though, and this is big and really kind of guiding investing decisions right now, but is in some of the consumer space, the consumer spending. We got news from J.P. Morgan a couple weeks ago about their earnings, and their earnings really showed strength in that credit and consumer spending area. Credit spending, so spending on credit cards, was up double digits in the first quarter, something like I think it was like 29%, up 29%, with a 60% jump in travel and related spending. Okay, so people are getting out of their houses finally. They're calling it revenge travel, right? Where they actually want to go on all the trips and stuff that they missed out over the last couple of years. So big spending, 60% jump in spending on travel and travel related credit card spending over the first quarter. And we also saw that in Google searches. Google searches for the fourth quarter for travel-related sites was up 41%. So people getting ready to do their traveling, planning their traveling, 41% up on Google searches for travel-related sites. And that's compared to a decline of 14% in overall retail and consumer goods sites, okay, for on Google searches. So you see a real discrepancy here during the pandemic when people were locked down. They were buying goods, they were buying, things that they could have delivered to their house. Now they're back to buying those experiences and those services and the travel, things like that. So something to watch for. It's really driving a lot of the stocks lately. We can look at the specific stocks and the sectors in a little bit here, but Capital One Financial, right, big in the credit card space, was up 2% last week versus a lot of the average for the financial sector was down 2%, so 4% disparity or discrepancy there. Host Hotels jumped 8 or 5% last week, okay, against a larger sell-off in a lot of that consumer discretionary retail space. So we're starting to see some real strength in those travel-related, the hosts, the hotels, leisure, and the credit card companies, right? And with, like I said, with only 20% of the S&P 500 of the market reporting so far, I think there's still a lot of opportunities in that in that theme. Okay, so you want to look for hotel and leisure stocks, credit cards, travel-related stocks. All the cruise lines have been up over the last month on that trend. So something you want to watch for as a lot of these other companies are reporting their earnings. I think you're going to get more upside surprises from a lot of those kind of themes and companies in those themes. So let's take a look at the market, see where we are opening. We are looking to open a little bit lower today, following on last week's down. Last week market was down pretty hard. Nasdaq was down like 3.5% last week, 3.8%. S&P 500 down 2.75%. 3 weeks in a row so far for the stock market down, marginally down today, 0.33% on the Nasdaq and the S&P 500. So not really with any conviction. It's just more of that negative sentiment coming through. And honestly, I got to tell you, a lot of the worries and the fears of the market don't really have any sense of clearing just yet. There's no sense of negotiated settlement or any kind of peace talks in Ukraine. The interest rates obviously continue to rise higher. And inflation, while there is some consensus that it might have peaked in this last month CPI, we won't know that until for about 2 weeks now, until May 12th, when the next consumer price index report comes out. That's going to show us whether that consensus idea that inflation has peaked comes around. So that's going to be very important to watch. If the market does start kind of believing that narrative that inflation has peaked or peaked last month with last month's reading, last month it was about 8.6%, so another 42-year high in inflation and consumer prices. If that does come down modestly on the 12th when that's reported, it would be a big positive surprise, positive catalyst for the market. And if the market does start buying that narrative, it could start rebounding earlier, maybe in the next week or two, just on anticipation of that news. But as of yet, we really don't get a sense of that happening. But as we talk about the markets and, as we watch the markets go down, NASDAQ is once again in bear market territory, down 20% from its peak of last year. S&P 500 still in that correction territory of about 11% down. As we look at that, against all that pessimism, just don't forget that when stock prices going down, this is really the time you get your best deals. Okay, could stock prices fall further? Of course they could. It's not only a possibility, but the trend is really in that direction right now. So it's a probability. But will stocks eventually rebound and make even today's prices look like a bargain? Yes. Again, the answer is yes on that. Look at any point in history when stocks were down 20% from their peak, or 30 or 40%, and really ask yourself, given where the market is right now, if that wasn't a great time to keep buying right back then. Okay, so I don't want you to get panicked or scared out of this market because 10 years from now we're going to be looking back and saying, damn, I wish I had kept on buying stocks and kept in the market. Not necessarily. You don't necessarily have to push all your chips in right now and buy all your excess cash with in stocks right now. But just don't panic sell out of your stocks. I see too many people now and then in past crashes I mean, I've been investing since 1999, been an analyst for more than 10 years, and I've just seen too many people panic out of the market, sell at this point, when the market is down 20 or 30%. And then they're gun shy and they wait, a year or 2 years or 3 years to get back into the market. They wait for stocks to rebound 20 or 30% before they actually, have that confidence to get back in the market. So they end up locking in these losses and then they miss out on a lot of the gains, on the other way up. So don't be scared of this market. Just remember, Amazon fell 95% to $5 a share, just under $6 a share in 2002. It is now up, so $5 a share in 2002. If you would have held on, it is now up over $3,000 each. So could have made a lot of money just by sticking with the companies that you believe in, and you trust that someday they're going to be very good investments. I want to look at the stock sectors of last week, kind of some of the stuff we talked about earlier, and kind of point those out. This, of course, is the sectorspider.com, one of my favorite resources here. You go to sectorspider.com, you go to tools, and you find the sector tracker. This is going to show you different time periods here, whichever you select, these 11 stock sectors and stocks in the S&P 500 and how they did, kind of give you that bird's eye view of how the stock market is trading, what investors see in each sector, and that kind of thing. We look over last week, and we did see two sectors posting positive gains: consumer staples and technology. Of course, consumer staples in that safety sector. You've got a lot of those food companies, packaging, things like that sell, or household goods, companies that sell things you have to buy, right? You need those Pop-Tarts, you need those Lucky Charms to live. So you're going to buy those no matter what, and those are going to have stable cash flows, and they're going to do well, during a recession and during a stock market sell-off. So we've seen consumer staples do well. Real estate did really well last week on earnings. Earnings are really good so far for real estate. It doesn't look like rising interest rates are hitting them that much. And of course, real estate is also a very strong inflation bet, right? So real estate as a real asset, as that physical asset, it's going to keep up the price. The values are going to keep up with inflation. So as inflation rises, the price of real estate rises, the rents that those real estate owners can get on that rises, and that tends to do pretty well also. Utilities was kind of surprising last week, down 2.4% last week. Utilities, obviously, along with consumer staples, usually one of the safety sectors, one of the sectors that does well when all other stocks are falling. What we saw last week in utilities, and you can always click through here to see the stocks in that sector within the S&P 500, kind of see how they did. We saw a big drop in NextEra Energy, ticker NEE, I believe, down 10% last week. Negative earnings last week, and it really shocked the market. That's a big part of that index, about 13% of that group. So it really drug the rest of the index down. But it wasn't only NextEra. You had AES Corp, NRG Energy, First Energy, all of those dragged lower on really fears, I think, that inflation is getting so high that these utility companies won't be able to raise rates quite fast enough to cover some of their own costs. So kind of interesting that the utilities was down last week. I would expect it to probably lag a little bit like consumer staples. We might have a rebound week this week, as we usually do when the sector falls in 1 week. Then it might get a rebound this week, but probably look for more weakness there. Again, consumer staples was really interesting, and we've got Coca-Cola reporting earnings today that were very good. So I think you keep on watching consumer staples, not only for that idea of safety in a stock market sell-off, but we're starting to see some very good earnings from a lot of these companies in the consumer staples sector. We'll talk about Coca-Cola here in a minute, but a lot of these companies, Clorox, ConAgra Brands, General Mills, a lot of these got hit really hard when inflation was just starting to rise early last year, really, right? Remember, a lot of these companies sold off very almost brutally last year on that inflation, the fear that they couldn't pass on those costs on to customers because inflation was just getting started. And I think the idea was that customers weren't necessarily ingrained into the idea of inflation yet, so that they were going to get that initial sticker shock if they saw a lot of these food companies and a lot of these household products companies raising prices. And the market was just worried about profitability in these companies. Now that we've gotten past that sticker shock, we know prices are going up, then a lot of these companies are being able to pass those costs on to consumers. So they're protecting their profitability, and the earnings are actually very good out of consumer staples companies. So we're starting to see that the stocks in that sector not only provide that safety in a stock market crash, but actually seeing some earnings growth in those companies, as well as with Coca-Cola. Some of these others, the communication services sector fell 7.7% last week. Big losses last week. Obviously, a lot of that was on Netflix and a lot of the streaming stocks. So we had those bad earnings out of Netflix that kind of put a warning bell across the streaming stocks. A lot of people coming to the conclusion that it is so expensive to create all this content, all these shows for these streaming companies, that it's really hitting the bottom line. Customers are obviously getting back out of their houses and off of their streaming devices. So we had some subscription loss there at Netflix, and it really shook. Like I said, it really shook a lot of these streaming stocks. The new Warner Brothers Discovery stock lost 17% last week. We had Paramount down. Meta platform. So Facebook was down another 12% last week. We'll talk about that. They're reporting earnings this week. So some really interesting things last week. Look at financials here. Financials were down 2%. But again, like we talked about earlier, if you look at some of the credit companies, okay, so Synchrony Financial, big credit company, Capital One Financial, big credit card company, both up last week versus the rest of the sector that was down pretty hard. So we are seeing some of these other stocks that are heavy into credit cards and credit spending. We are seeing some strength in some parts of the financial sector that you want to watch for. So I want to look at what to watch, what I'm watching for this week. Then we'll look at some of those stocks that we're watching, including the big tech stocks that are reporting earnings this week. Takes center stage, obviously, part of the 175 companies in the S&P 500 that are reporting earnings this week. So it's going to be interesting to see if they can carry on that outperformance in earnings and see how well they do. Honestly, I'm not real optimistic on some of the tech stocks. They have been reporting very good revenue so far, especially international revenue for a lot of the tech companies. But we are starting to see the wages and those operational costs come through into those. Okay, like I said, last year we started to see inflation really hit those consumer staples companies, the food companies, household products companies. Now we're starting to see that inflation kind of bleed through and come through on these tech companies. And the reason why is a lot of times what happened last year is the inflation first started in a lot of those supplies, the materials, the agricultural commodities, things like that, to really hit those industrial and the consumer staples companies. But it didn't necessarily hit the tech companies, right? Because they don't buy a whole lot of stuff to go into their products. It's mostly just their IP, their intellectual property, and their people creating those products and managing those websites and whatnot. Well, what's happening now is we're starting to see that inflation bleed through into other costs, bleed through into operational costs like marketing, like wages and that kind of thing. And so you're starting to see these tech companies really get hit by those inflationary pressures, especially wages. One really interesting idea on this inflation theme is that right now with the job market so tight and with companies having to offer higher wages to their new employees, that's creating a real discrepancy between the wages of new employees, people just getting hired in this market right now, and the older employees. So I think you're going to see some real lasting effects of this of these higher wages down over the next year or two. Okay, you're going to start seeing a lot of the older workers that are still, working for some of the wages that they negotiated last year and the year before that, start saying, well, just a minute, little Johnny here, he's the new guy, 6 months in the job, and he's making more than I am. So I want a bigger wage increase this year. So I think you're going to start seeing higher wage increases from a lot of these companies, especially the tech companies, where they're having to hire new people at higher wages than their old salaries were. So be watching for that in the earnings, what management says about that. The Federal Reserve is The personal consumptions expenditures, the PCE report is scheduled out for Friday. Now that's really the third big inflation report of the month. Okay, so earlier in the month we have the CPI, which is the Consumer Price Index. We have the PCI, the personal the producer's price, the PPI, the producer's price index, right? Which is, okay, so the consumer price index, obviously consumer prices, PPI, producer prices, so what are producers paying for in their inflation and things like that. And now the personal consumptions expenditures, which kind of measures personal spending, inflation in that segment, as well as wages and that kind of thing. It's really what the Fed uses most in its inflation gauge to really see, okay, how fast is inflation growing? How much do we need to bring it down? How high do we need to increase rates? The thing is, it comes so late in the month. It's usually about the last week in the month that PCE report comes out. We've already seen the other two inflation reports come out before it during the month. So it's kind of a non-event a lot of times. It is expected to grow, another major increase in inflation on top of 5.4% last month, I believe, in February. But again, the market is really waiting for the big story, which is going to be the Consumer Price Index, the CPI report, next on the 12th of May next month, to see if inflation has really started to moderate a little bit or if it's still increasing. I'm kind of in the camp. It's kind of starting to come around to the idea that it should start moderating a little bit. Even if it comes down from 8.6% last month to 8.2 or 8.3%. Any movement in that direction coming down would be a very welcome surprise for the market, and I think could be some support for stocks. But of course, that's still another couple of weeks. So we're still kind of in that wait and see mode, I think, for that report, or if the market is going to kind of latch on to that report. Want to look at some of the stocks that we're watching this week, especially the stocks that are reporting earnings this week. So we've got Coca-Cola that actually reported its earnings this morning before the bell. Were very good earnings, and this is part of what we're talking about with those consumer staples companies. Okay, Coca-Cola reported that it had been able to increase prices by about 7% on average across company-wide, and even higher in some of the other regions. Latin America, I think it said it raised prices upwards of 11% and more in that region, and didn't suffer any kind of volume sell-offs on that. It reported higher prices, so that 7% overall increase in prices, as well as a higher sales volume as well. So I think the idea, like we talked about, the idea that consumers have kind of bit the bullet and embraced the horror that those prices are increasing on pretty much everything we pay for. And so it's not necessarily that sticker shock that we got from these companies last year. So I think these companies are finding that they can increase their prices to cover the costs and protect that profitability. So that's where you're seeing some real strength here in these consumer staples companies. Coca-Cola up 1.5% pre-market. So it does look like it's going to rise this morning on that news that it reported. Getting into the big tech stocks, the tech stocks reporting this week, all the major tech stocks. Microsoft report starts us off on Tuesday with its report. Analysts expecting about $2.18 a share. That'd be about 7.5% higher from last year on about $50 billion in revenue. Microsoft has been booming really on cloud services component, as well as PC sales. Sales of personal computers have been really strong over the past couple of years as people kind of refurbish or buy new PCs to work from home and that kind of thing. But I would be worried here, because obviously if we're heading into any kind of a recession, a slowdown, companies may be slowing down on their cloud services spending. That component will still probably be pretty strong. But I think there's no doubt that PC sales are going to be slowing through the rest of the year. And we could get kind of a negative outlook on from Microsoft. What a lot of these tech companies, a lot of these companies in general have been doing is beating their earnings expectations, reporting good earnings for first quarter, but then saying, the next 3 quarters, the rest of the year might not be quite as good if we do get some kind of a slowdown or even a recession in early 2023. So, with the shares already trading at very expensive at 10 times on a price to sales basis, I mean, Microsoft it's a strong stock. It's a strong company, one of the most popular stocks in the market, but it is trading in growth stock territory at over 10 times price to sales. So any kind of negative outlook for the rest of the year on earnings, on sales, it could be another stock to get hit, on that news. And that reports on Tuesday. Alphabet, Google, ticker GOOG, also reports earnings on Tuesday. Analysts expecting a big drop in earnings to $26.11 per share. Actually, not a huge drop. $26. It's about flat to slightly lower from the first quarter of last year. Sales are expected higher though. So again, we're getting kind of that confusion, kind of that outlook that sales are growing. Companies are able to increase their prices, increase their volume as well, and doing well on the sales side. But that the costs, the operational expenses are really starting to eat into the earnings picture for a lot of these companies, especially the tech companies that are just now starting to see that pressure from wages. So, a company is likely to beat these lowered expectations. I do like shares of Google, as a long-term investment. I'm not saying that they couldn't take a hit tomorrow if they do give some kind of a negative outlook. But, basically you got a lot of these tech stocks. Google, Amazon is another one that we'll talk about that I think is fairly valued, at this point. Could drop further with the market. But I think with Google, you're getting very good value on the cloud services component, the search the search component, and the YouTube component, and then you're getting a lot of these other investments that Google has, things like Waymo, self-driving, things like their AI unit, things like that aren't priced into the stock, and could be good future long-term growth. One of the few stocks that I think is oversold and could actually bounce on earnings. Facebook, so Meta Platforms. Again, I will never in earnest call it Meta. I don't know why they changed it, but anyway, Facebook, ticker FB, reporting earnings on Wednesday. Analysts expecting a steep drop here, from $3.30 a share reported last year to just $2.56 a share for the first quarter of this year. And again, no doubt it's still feeling the effect of those Apple privacy changes. It will for the rest of the year. But I think a lot of that is really priced into the stock right now at this point. Shares of Facebook are down more than 50% since its peak last year, well over the losses we see in a lot of these other large tech companies. The FANG stocks, most of the FANG stocks are down 20% at the most. Facebook, again, down more than 50%. Shares trading at 4.4 times on a price to sales basis. That's about as low as it's been in the last decade, definitely, and even further out. So I think Facebook is one that you could probably kind of look to pick up shares on the rebound there. Again, reporting earnings Wednesday. And the competitive advantages in this stock are still pretty strong in the social space. Okay, it's got a scale and a scope that is just unmatched. Okay, no other social platform really has that kind of ecosystem of other sites. Okay, so with Facebook, you get Instagram, you get WhatsApp, you get Messenger. With a lot of the other social sites like Twitter, like TikTok, what have you, it's just the one singular site. So you don't have that scope. Overall, you don't have the scale either. Okay, Facebook still reports 3 billion active users monthly. Which is just unheard of on the other sites. And it does get a pretty good average revenue per user compared to a lot of these other sites. So, I think Facebook is probably one of the few very oversold companies, tech stocks here reporting this week. We've also got Amazon. We'll have to open up the window for that. Amazon reporting this week, reports on Thursdays. Wages is really what's going to be watched in this earnings report. Wages and what the management says about those worker unionization efforts. Okay, big news to watch. A lot of these factories warehouses for Amazon across the country are unionizing. It's going to be driving up operational costs. So those operating costs, those wages are really ballooning, and investors need to see that management has a plan to cap that rise in costs, or at least somehow make up for it by passing costs onto the consumer. So I do like Amazon again, just like Google. I like Amazon for that long term. I do think there is some weakness here and some danger that it does fall further, especially if they really come out with a negative outlook on those wages and on those operating costs. So I wouldn't necessarily buy in all the way into here, but I think you can start putting in a position here with Amazon. I'd like to see it maybe down a little bit lower, maybe down around 2,500 a share or a little bit lower than that. But, we've got some real evidence that it is undervalued, even on a sum of parts basis. Okay, so Dan Loeb, hedge fund activist investor, put out a research comment last month saying that Amazon should be worth about $2.5 trillion. So about 70% more than where it's trading now. Just if you break the company up between that e-commerce segment and the cloud services segment and value those separately, then it could be worth 2.5 trillion rather than the 1.5 trillion it's trading at right now. So long term, it's another good stock. Short term, probably has some downside in the earnings on Thursday. Apple is going to be another big one. Everybody's watching. Reports earnings on Thursdays. Investors really worried about this one as far as those factory shutdowns in China, how that's going to affect the outlook for the coming quarter, for the rest of the year. And honestly, it's just really hard to get excited about this year's product cycle coming out of Apple. And that's one thing you really got to understand about Apple, especially the short term. Now, obviously, the long term, it's still a very strong company. They're going to constantly continue to reinvent different kinds of products and gadgets and be able to sell those to everyone. But the short term, on the shorter term, from any year to year in Apple, it is all about that product refresh cycle. What new products do they have coming out in September to really get people excited about buying the products again? And honestly, I got to say, I mean, looking at the products they've got coming out or rumored to come out this September, nothing is really that exciting just yet. So you get a real sense that, consumers just aren't going to be there this year for Apple like they have been in maybe the past couple of years. And so you might have some real weakness on the 2022 outlook in there when they report on Thursday, as well as just what they say about the factory shutdowns in China and how that's going to affect sales for the rest of this quarter. Last one here, Bed Bath & Beyond, ticker BBBY, actually had some good news last week, reported in the Wall Street Journal that interest is developing from private equity and SPAC companies to buy their Bye Bye Baby segment. So this is something that, GameStop chairman Ryan Cohen took a big position in the stock, bought up a lot of shares of Bed Bath & Beyond, and is actually actively pushing for them to break up the company, to do something, to unlock some of that shareholder value. So we did get news that there was some interest in buying that segment. We don't know. Obviously, we don't know if they're actually going to sell it or if that's ever going to come to anything. But it was up something like almost 7% on Friday. It's down today, probably some give back on that. And the fact that we haven't really heard much follow-up on that report, whether the company does actually want to sell that or wants to try to turn it around. So I want to talk about a couple of other ideas that kind of looking at over the weekend here and over the news. Actually had some big news out of cryptocurrency last week, and Morgan Stanley actually said crypto could become more widely used as a currency. Something we saw last week was a partnership between Strike. So what happened is a partnership between payments company Strike announced a partnership with point of sale supplier NCR. So if you don't know, NCR is they basically make all those little credit and point of sale devices that you see at retailers. Anytime you pay with a credit card or a debit card or things like that, that is probably an NCR device that you're using, as well as payments firm Blackhawk Network. And really what this is going to do, it's going to enable a large number of U.S. stores and restaurants to soon be able to accept Bitcoin or other cryptocurrencies as a payment. Okay, and how this is different from what we've already got set up is, one, the Lightning Network on Strike is significantly cheaper than fees. Fees are close to zero for paying paying with Bitcoin on that network than compared to, purchases on credit or debit cards for these retailers. Okay, so there is an incentive there to try to switch to some kind of crypto or Bitcoin payment. Now, of course, what we've seen in the past is retailers don't want to do this because of all that volatility in Bitcoin. They don't want to take $100 worth of Bitcoin, and then by the time they get around to converting it into dollars, it's only worth $80. Right? So what this partnership is going to do, it's going to allow the retailer or the restaurant to be paid immediately in dollars, converted from the Bitcoin from the customer's purchase. The customer can pay in Bitcoin. It's immediately converted into dollars at that rate. So there's really no difference between between being paid in dollars on a credit card or being paid in Bitcoin, through this network. And the fees are going to be much lower for the retailer. So, it could be the start of wide scale adoption by restaurants, by retailers, or just, being able to offer that service. So obviously a very positive catalyst for cryptocurrency and especially Bitcoin. So that's really what I'm looking at this week. I want to open it up to Q&A, favorite part of the live stream, just kind of looking at your questions, answering your questions there. Let me know in the comments what questions you have. If I don't see it, be sure to use a question mark so I see it's a question. I'm going to scroll up here and see what we've got here in the comments. Again, love seeing all the everyone out there in the Bowtie Nation there in the comments and in the chat. Look at IVR. So Nemo wants to know about IVR, and for some of these, so IVR I haven't looked at. We can look at it here and see real quick. I can give you just kind of a first impression. Mortgage Capital. So this is a mortgage REIT, right? So this is a lot. You got to understand, folks. A lot of these. The market is going to determine the direction for a lot of these stocks. And here what we're talking about here is these mortgage REITs, especially with rising interest rates, with a flattening yield curve. What happens to these mortgage REITs is they borrow on those short-term rates, right? They borrow at rates, on the very short-term end of the yield curve. And then they leverage that up 3, 4, 5 times to buy mortgage bonds, right? To buy mortgages. Well, so mortgage rates are going up, interest rates are going up on the long end of the curve, and that's good for these companies. They'll make more money investing in those. The problem is the short-term rates are going up just as fast or faster. Really, we're seeing a kind of a flattening yield curve where the short-term rates are just as high as those long-term rates. So it really does these companies, these mortgage REITs, these mortgage companies, no good to be able to borrow at those short-term rates if they're right around the same as those long-term rates. Now, so you're going to see a lot of these mortgage REITs, they are just falling like crazy over the past year. So you've got IVR here down from $3.90 a share down to $1.77 today. You see that in all the mortgage REITs. And the thing you need to understand, though, is this might, like a lot of stocks, this might be the best time to buy. Okay. There is pain. You're going to see the stocks sell off, but as long as you're buying good quality companies, and I can't say necessarily that Invesco Mortgage Capital is a quality company. I haven't looked at the stock, haven't looked at the company much. Invesco, obviously a huge financial firm, so probably in no danger there. I happen to like a few of the other mortgage REITs. Two Harbors is a good one. Chimera is another one that's talked about quite a bit. A lot of those other ones, if you invest in these MREITs, just make sure you invest in large established companies that are obviously in no financial or liquidity danger. As long as you do that, eventually they will rebound. These are obviously, we will always need have demand for mortgage REITs, for these companies buying these mortgage bonds and supplying that kind of demand for mortgage bonds. With the Fed, over the last couple of years, the Fed has been buying up a lot of mortgages, right? Mortgage-backed securities. They're not doing that anymore, right? They are stopping that program, buying fewer mortgage bonds each month for their balance sheet. So what we're going to see more, more demand for these MREITs, in the economy. So definitely not going anywhere, but the stock prices are hurting from that change in the yield curve. So just something you want to be aware of. They will, dividend yields are going to come down as the profitability for these companies comes down because of those rates. The dividend yields are going to have to come down to protect cash flow and to protect the company. But eventually, when those interest rates do stabilize and the long-term rates go above the shorter-term rates and they become more profitable once again, these will be good stocks and high dividend yields to buy. Okay, let's look at what else we got here. Ambrose, good to see you there. Greetings from New York. Joe, good to see you. GM. Kenny Scott wants to know about GM. Honestly, I hate to tell you, I can't tell you much on GM because I just haven't looked at it in a while. I know for a long time, a lot of the legacy automakers were just, the stocks were just surging. Ford is another example, surging on those, those hopes for electric vehicles. And really got kind of overpriced. I think they've come down since then. So let me put GM on my list of stocks to look at over the week. I'll give you a full rundown next week at next week's live stream. But I don't want to just give you a real quick, hey, this is what this is a yay or nay decision kind of thing. What else? Whatever. That's an increase in fees. Visa increasing fees to $700. So Fuhat wants to know about Visa increasing its fees to $700. I'm not quite sure what you're talking about there as far as 700, maybe 700 basis points or something. But like we talked about, a lot of these companies, they're finding that they are able to increase their fees, increase their prices, and customers are buying it. With Visa, what choice do you have? Yeah, there's not going to be much of a choice other than Visa, MasterCard, Discover, a lot of these major credit companies. You're not going to switch your credit card just because fees go up a little bit. You might look around, but on the margins. But most of these companies, they are finding that they are able to raise their prices. So I don't think and I think everybody's doing it pretty much at the same time, right? Everybody's making these announcements. So I don't think you need to worry too much about volume or sales destruction or demand destruction on these companies that are increasing their rates. You have to be watching the profitability for these companies as well. And the ones that are able to increase their rates, increase their fees and prices, to protect that profitability, those are going to be the best stocks to have because those are going to be the ones rewarded by the by the market. Robert wants to know how hard was it to get the CFA, right? So very hard. It is the hardest test by far that I've ever taken, or the hardest 3 tests, right? What he's talking about is, you see the 3 little letters after my name, CFA. It stands for a Chartered Financial Analyst. It's really kind of the gold standard for financial analysis. People working on Wall Street, right? It's a 3-year program, self-study. The books are about that thick, about 6-7 books each year for 3 years. Each year you take a 6-hour closed book exam, so basically everything out of memory. For 6 hours each year. Pass rates about maybe 1 in 5 people that take the tests actually pass them. So it was extremely hard, but it's great information. I'd say even for people that aren't looking to become a professional analyst or work on Wall Street, if you're thinking about picking stocks, analyzing stocks and things like that, there's no better education than going to your local library, finding some of the older books, the old curriculum, a couple of years old, still going to be the same information basically, checking those out and really studying, especially the level 1 curriculum. Okay, the level 1 CFA curriculum is really kind of the basic analysis kind of stuff. So you read over some of that and it's great information, but yeah, very, very hard. It's average is about 300 hours each test as far as studying. I think I spent about 400 to 500 hours for each test. So 3 years in a row, 400 to 500 hours studying for each one. So that's how hard it was. Good question though. What else? Let's talk. CFA worth it. Fuhat asks if the CFA was worth it. Yeah, I think it was, in the big picture of things. Okay, so it's self-study, so it's your time. Basically, you give up, 3 years worth of Friday nights, right? You give up a little bit of time to commit to study and make yourself a better investor. And it has gotten me jobs. It has gotten me freelance jobs as well as traditional analyst jobs, things like that. Places that I couldn't have worked for without the CFA, without that designation. So it has gotten me some pretty good analysis work, in the past. For regular people that don't want to be an analyst or a professional analyst or work on Wall Street, again, you probably just fine with studying the level 1 books, just doing some studying and getting that basic information to be a better investor. Melanie there from Seattle. Morning. What's the last name? I was a greeting from Belgium. That's cool. What else? What else do we have here? What about Twitter? So big news. Daywood wants to know about Twitter. Obviously, big news this morning that and over the weekend is that the Twitter board, the board of directors at Twitter, is actually considering Elon Musk's buyout proposal. So this would be pretty major, right? The Elon Musk actually buying Twitter, taking it private, so to speak. I guess I don't know if he would take it private completely or keep it publicly listed or what, and just own a majority of the shares. But that's really interesting that he would have control over over the social media company. So obviously he loves to use Twitter and that kind of thing. It's at this point I think it's fairly valued, especially with the news out this morning that they are considering the deal. We can look at where it's trading at today, and I can almost tell you it's got to be up today if they're considering the actual offer. So we got another 2.8% up today. Market cap is at $38 billion. Now the offer was for $43 billion, I believe. So there is, if it actually comes to something and he actually does buy the company for $43 billion, I mean there is some room in the stock for upside. So we got $43 billion buyout divided by 38 where it's trading now. So there's about 13% upside to that buyout offer. Now you got to be careful though, because whether that actually ends up happening. We can look at year to date, see how much it's come up. Yeah, see, I mean it's come up from $38, $39 a share before he released his stake, his interest in the company, to $50 already. So it's already come up so much. Basically, it is trading on the idea that he is going to take it private or buy the company. So, if he does that, again, about a 10%, 13% upside potential in the stock if that actually comes. But, again, there's just still a big question mark whether he's going to do that, whether he actually wants to do that. You remember at one point he was saying that he had funding secured and he was going to take Tesla private, and that never happened. So, and the board of directors of Twitter is still considering the offer, considering what to do. So I don't know. I think the downside risk is there. It wasn't only a couple of weeks ago that a lot of people were saying that there was nothing to the bid, that it was just kind of shenanigans, that he was kind of playing with Twitter and playing with people actually making that offer, and that he really didn't want the shares of Twitter anyway. So I don't know. I would think there's probably more downside risk than there is upside in that. What else? Just made a video about panics. Sometimes sell lower thoughts on Upstart. Yogesh wants to know about Upstart Holdings. Really haven't looked at Upstart for a while. I like some of these others. I like SoFi a little bit better, in that kind of fintech space. I like SoFi mainly because it does have a banking license, so it's able to do a lot of the traditional banking things that a lot of these other fintechs cannot do, like Upstart. Upstart does not have that banking license, so it can't offer the savings accounts, checking accounts. It doesn't get access to some of those lower interest rates, that it can offer, that it can make a spread on, like SoFi does. We see it is up in the market today. Year to date, obviously hurting along with the rest of those those tech stocks and those growth stocks. Really, Upstart, what I didn't like about that, and a lot of these growth stocks and these hot stocks over the last years, when they did come to market on those SPAC on the SPAC issues and things like that, they were just tremendously overvalued. We can look at the valuation on Upstart, see where that is right now. So that is still at an 8.4 times price to sales basis. Obviously, not terribly expensive like it was last year. It's come down quite a bit. It's still pretty expensive, on that price to sales basis, but it is under that 10 times price to sales that I usually look for as kind of an initial decision, right? It is still very much a growth stock. Okay, we have a revenue growth year over year of 250%. You can look at the financials here and look to see really how fast revenue has grown. So last year grew to 841 million from 227 million the year before, really accelerating over the last year. The problem is, how fast can it grow this year? How long can it keep up that growth rate? And is it worth that 8.5 times price to sales? Again, haven't really looked at it that much. I do like SoFi a little bit better on the fintech space and on that idea. But Upstart is a solid fintech company. It's going to be around. It's just a matter of, like a lot of these stocks, the market is going to push a lot of these stocks in the direction it wants to go in. Okay, if the market falls, a lot of these stocks, these growth stocks, are going to continue to fall as well, whether they are great companies or not, whether they are great long-term buys or not. So you really have to be, if you've done your research in the stock, if you like the company, if you think it's going to be around and going to be a growth company for a long time, you still have to be ready for that pain in the stock, in the shares, and be able to wait it out. Again, just go back to that analogy of Amazon. Amazon, after the .com crash, fell 95% down to under $6 a share. Now look at where it's trading now. Okay, a lot of these growth stocks, a lot of these great stocks are going to be, 10, 15 years from now, are going to make you a lot of money. But you have to be able to have that intestinal fortitude, right? The guts to stick with the ones that are good companies. Danny wants to know, how's my weekend? My weekend was kind of a bummer. I worked throughout the weekend. I didn't get my usual Friday night Twilight Zone marathon and Jack Daniels, so it kind of feels like there was no weekend. Last week kind of bled into this week, but I'm gonna do that tonight. I think I'm gonna have my glass of Jack on the Rocks and watch a few episodes of Twilight Zone and kind of relax and pass one week on to the next and get ready for this week. Anyway, thank you for that though. I heard Tesla is copying Apple, that they will sell their car and charger separately. I hadn't heard that. That would be interesting news. Tesla, obviously, a stock to watch. Elon's mad at Bill Gates recently. I guess Bill Gates and his investment company is shorting shares of Tesla, or so I've heard. So obviously there's a little bit of a feud there. Never underestimate Elon Musk for his ability to keep the company in the news, keep investors, riled up about the shares, and kind of create that cult of personality around the shares. So it's hard to write Tesla off on anything because they do have that kind of cult following that is going to support the shares. Consumer staples, REITs, and utilities. Let me roll over last view on Citibank. Kenny wants to know about Citibank. And Citibank, as well as all the other bank stocks, they're not going up because of that rate picture. Okay, what we're looking at, there's two things really holding Citibank, Bank of America, Wells Fargo, all of those banks really holding them back. One is that idea that we talked about with the yield curve. Okay, because understand how banks make money is they pay you those short-term rates on the deposits, and then they lend that money out on the longer-term rates and mortgages and things like that, right? So their profit is the difference between those long-term rates and the short-term rates. Now, with those short-term rates going up, I know a lot of banks, a lot of savings accounts still not paying very much on those deposits, but they are going up, right? So with those short-term rates going up and the long-term rates going up a little bit, but not quite as much, then that's kind of squeezing the profitability for a lot of these banks. So that's one thing. The other thing is just kind of the fear that the higher interest rates and higher mortgage rates and all this stuff is going to cause an economic slowdown. So, of course, obviously, the banks are worried about that. Investors are worried that a slowdown is going to hurt the profits and the earnings for these banks. What we've seen over this last quarter really is a lot of the banks moving. Same thing we saw at the beginning of the pandemic. Okay, the banks are moving a lot of their money from their income statement before it hits earnings, moving that onto their balance sheet in that loan loss reserves account. Okay, that what if account. This account on the balance sheet called the loan loss reserves, loan loss provision. This is a what if account. This is an account that they build up just in case loan defaults get bad in a recession. Okay, so a lot of these companies, a lot of these banks saying that, you know what, we're not sure if a recession is coming, but we want to make sure just in case we have this money set aside just in case the loans start defaulting. So they've moved a lot of that money off of their income statement. That's driven earnings down. Earnings for banks were down like 35% in the first quarter compared to the same quarter last year because they've moved all this money off. Now, what I think is that if we don't get just a huge, full-blown, massive recession, then just like we saw in the pandemic, they're going to start moving a lot of these loan loss reserves back onto the income statement. This isn't going to happen until probably early or mid next year, but it will happen. It will happen that we're going to start seeing the opposite of this. It's going to start boosting earnings, and these companies are going to do well. Okay, as far as Citigroup, I do like Citigroup. It is probably the cheapest bank stock you can find. It's paying a 4% dividend yield and trading for a price to book of just 0.56. Okay, this is really the valuation you want to look for on bank stocks. Okay, since they put all those the deposits as liabilities on their balance sheet, they put the loans that they own or they invest in on their balance sheet as assets. They really have a book value of their whole business right on the balance sheet. So you really want to look at the price to that book value when you're measuring the valuation for these stocks. Okay. And if you just compare the Citigroup against some of these other bank stocks, Citigroup trading for 0.56 price to book. Okay, let's compare that to Wells Fargo, WFC. I think that one's trading for like 1.05 or something like that, somewhere around there. And also, not necessarily overvalued either, but 1.1 times price to book for Wells Fargo. So, we can say that relatively, so Wells Fargo is trading for 96% more, 96% premium than Citigroup. Okay, so you got to ask yourself, do you really believe that Wells Fargo deserves to be valued at twice what the book value of what Citigroup is? Is it twice the bank, right? Does it have that much better of services, operations, cash flow, that kind of thing than Citigroup? You look at some of these others. So we'll look at Bank of America next. We've got Bank of America, and I believe that one's even more expensive. I think Bank of America is around 1.2 times. Last time I looked, 1.2, 1.3 times price to book. So here, 1.26 times price to book for Bank of America, almost 1.3 times. So are we really saying that Bank of America is worth 1.3 times its share price is worth 1.3 times its book value, when Citigroup is only worth 0.56 times? Okay, so just on this relative valuation, this comparison valuation here, back and forth, we can see that Citigroup is very, very much underpriced. If we do look at the history of price to book for Citigroup, it does trade a little bit lower, but even the 5-year average is closer to 0.8 or 0.9 times on a price to book value for Citigroup. So Again, like a lot of these stocks, it is going to be pulled down by the market. It's being pulled down by some of these other factors, but it is a very good price right now. And I think over the long term, if you can stay in the stock and not get scared out of it, then you can make very good money on some of these value bets. Okay, what else? VDC, that's right. Okay, what else? Just kind of scrolling through, looking for questions here. Again, please try to use a question mark. So TX Gold Bull wants to know, should I invest in Google now or wait for the split? Like a lot of these we've talked about, Google is splitting. I think Amazon is splitting its shares. Really, a stock split is it works for investor sentiment, but really for nothing else. The fact that they have twice or 3 times as many shares really doesn't change the company or the valuation. And what we see a lot of times on these stock splits, a lot of times the stock price will go up, ahead of the split and maybe even a little bit afterwards as more investors get into the stock. But then it kind of comes down afterwards because it's still the same company and it still deserves pretty much the same valuation, right? Investors are still going to be willing to pay right around 4 or 5 times price to sales for Amazon, whether it has, 1 billion shares or 500 million shares, right? So a lot of times, you are better off buying ahead of the split, so to watch it go up a little bit, but then don't be scared out of the stock if it comes down a little bit after the split as well. Again, you gotta go with these companies because you believe in the company, you believe in the long-term prospects in the company, and you really like the stock. And for both of those, I do like the stock on that long-term basis. Google and Amazon, I think they will bring in more investors, certainly, but I think just the long-term growth in both of those companies is very positive. So I think if you want, and understand, folks, there's a lot of people, they want to know, should I buy it now or should I buy it later? Well, why not both? The idea of investing is not so much getting those huge returns one time. It's making it more like a savings account, honestly. And it's not the sexy way to invest, but investing every month, investing every quarter, every 3 months, putting your money to work, and make sure you continuously grow that account from your own deposits as well. So buy a little bit now, buy a little bit in a month, buy a little bit in 2 months, and just keep on buying, over the next few months. Again, this is as stocks are coming down, as stock prices are coming down, and everyone else is selling, everyone else is panicking. This is the best time to keep buying, to continuously buy those shares on the way down, because eventually they will rebound, over the long term. Okay, Ronak wants to know about SoFi and Robinhood. Already talked about SoFi. Again, I really like the stock. It's one of my largest positions, actually, and probably my largest fintech position, just because it does have that banking license. I think it really has a competitive advantage on a lot of these other fintech stocks, these online banking stocks. Obviously, SoFi is going to be hurt. It's going to be limited until we get the lift off of the moratorium of student loans. Okay, so SoFi started as a student loan company. It's still very much a student loan refinancing company and that kind of thing. So as long as people aren't paying their student loans back, then SoFi is going to be limited as far as stock price. Eventually, we're going to get that moratorium lifted. People aren't going to just stop forever paying their student loans. So eventually, we're going to get that lifted, and SoFi is going to take off. And then over the long term, it's going to be a very good stock. Robinhood, it's very hard to recommend Robinhood. Even at these levels, it came to market very, very expensive on a valuation basis. It's still pretty expensive. And with Robinhood, I think they're losing a lot of their competitive advantage. They're losing, obviously, a lot of their revenue is in that cryptocurrency trading. That is more than half, I think, of their revenue at Robinhood is the cryptocurrency trading. So they're kind of tied to cryptocurrency, tied to the future of that. So myself, I would much rather just buy the cryptocurrencies directly than have some of these side bets, through Robinhood, through Coinbase, through some of the miners, things like that. Because we've talked about this on the channel before. I think cryptocurrency can do well. Obviously, if cryptocurrency does well, all these side bets, Robinhood, Coinbase, that kind of thing, are going to do well also. But not necessarily. I mean, there's a lot of competition there. Fees are going to start coming down for cryptocurrency trading, things like that, are going to start hurting these companies. They're going to have to start diversifying away from some of those trading fees and things like that. And I just don't see it happening just yet. So I would be, I would still be a little worried about Robinhood. Okay, what else? Thoughts on the J&J split? Hadn't really looked much at the J&J split, or J&J in particular, but it is part of that consumer staples story that we talked about earlier in the video. I think consumer staples, they are really the standout in this market, in the idea that, one, they give you that safety because the cash flows at these companies are very stable, so they're going to give you that safety in a stock market sell-off. Actually looking at some data for a video this next week coming up, into the 2008 crash. Okay, so from the October 2007 peak in the S&P 500 down to the low March 9th, 2009, consumer staples companies in that sector only lost 28%, right? 28%, and that still sucks. That's still almost 30% off your money. But that's compared to a 55% loss on the broader S&P 500, on the larger market, right? So fell almost half as much as the market. So consumer staples, J&J, they're going to protect your money in a sell-off, but they're also starting to report very higher earnings now. as they're able to increase their prices and cover their own inflation costs and things like that. So, J&J, haven't looked at it particularly over the past few months or anything, but all those consumer staples companies, they're ones to watch. Okay, cans of Coke. I don't have Coke products in my house. Maybe the growth of Coca-Cola is getting people restaurants more. Meta means love, I think. In Greek or so. Oh, that's interesting. So Mark says that meta means love in Greek or Stoic philosophy. I would have to check that out. I mean, generally meta, you think of meta as, kind of the second order research into something. So meta research would be research about research. That's interesting. We'll have to look that up. Land split. Okay. Looking for questions here. 5 years until retirement. Any investment suggestions? Great question. Joe wants to know investment suggestions for 5 years until retirement. That's the problem. That's the real scary thing with this market. Okay, because like I said, you can. I think some of the best deals you get as the market is falling. So you hold on, you keep buying stocks into that weakening market, and eventually, it's gonna rebound. 10 years from now, 15 years from now, you're gonna have made a lot of money. The problem is for that group of investors that is 5 years out of retirement, you probably do not have the time to rebound from that market. Okay, so it took the Nasdaq 14 years to get back up to that 2000 peak, right? The dot-com crash from 2000. It took them 14 years for the Nasdaq to get back up to that point. So obviously, if you don't have 14 years, then it's worrisome. It's a little bit dangerous to say just keep buying and hold on, okay? Because you don't have that time. What I would suggest is just start protecting some of your money. We've got a video on I bonds, Series I savings bonds coming up this Friday. Probably the best opportunity in investments right now. Those Series I savings bonds, they're going to start in May 1st. They're going to reset their rates. Probably going to pay a rate of around 9% a year. And that's guaranteed. It's a U.S. savings bond, so it's guaranteed 9% interest rate or whatever they reset it to. You're guaranteed you're going to get that for at least 6 months or a year. I would start, if you do have very limited time to needing that money, you cannot afford to see stocks go down anymore. Okay. Now, obviously, I don't know your portfolio. I don't know how much you've already got set aside, but most people, they cannot afford to lose another 20 or 30% on their stocks if we do get, that full-blown stock market crash, into the rest of this year and into next. So you really got to be careful with that. So at this point, 5 years until retirement, I would seriously start considering maybe something like a bucket strategy where you have one bucket, so one portfolio or one set of investments that is all just in cash. Those savings bonds, very cash-like investments, right? Stuff that you can convert immediately, get that cash out, and pay for expenses, right? You need at least 2 or 3 years of that in that bucket so that you don't have to sell your stocks. Because what happens is, you need that cash for retirement, and you end up needing to sell stocks to pay for that, and you sell them at the worst possible time. So that's really what you got to watch out for. So for those of you out there with less than 5 years until retirement, I would really say you really do need to get protect your money and get defensive at this point, because you can't afford it to get much worse. Okay, I think I'm gonna go ahead and close this one up. We're heading on over an hour here. Thank you for being here again. If I didn't see your question, please ask it in the comments below. I'll try to answer it later on in the day. Love doing these market news roundups for you each week, Monday at 9 a.m. So looking forward to seeing you next week.